I just do these videos to show people how to get a piece of the pie and understand that investing can be easy if they use a little common sense and are willing to learn something new. What's up, guys? It's your boy Ty, coming to y'all with my game-winning portfolio 9. I can't believe this is the 9th one. Today, the market was a little shaky. It was a little shaky, but we're gonna get into that. I do these videos to show people that it's easy to invest if you apply yourself and are willing to learn a little bit about the market. It doesn't take much. You apply a little common sense to the stock market and investing, and you will be okay. Start off, let's go ahead and get it out the way. This is not financial advice. If you need a financial advisor, please seek out one. Again, I just show you guys what I got going on and how easy it is to invest. All right, so we're on my game-winning portfolio. I'm on Dividend Watch. Dividend Watch is a stock portfolio tracker and is specifically made for dividend investing. I like to invest in dividends when it comes to stocks. And if you guys want to sign up for Dividend Watch, I'm going to leave a link in the comments and in the description on this video. You can sign up for Dividend Watch. Dividend Watch is an independent financial tool that doesn't show ads or doesn't sell your data. With one subscription, you get a portfolio tracker, advanced dividend calculator, and stock screener, all connected. That's the reason that more than 5,000 investors are using Dividend Watch's portfolio tracker. Of course, you guys see I'm currently active, and you can get discounts if you sign up for annual billing, but you also get a discount if you use the promo code TY15, and you get 15% off of your first year's membership with Dividend Watch. That's an exclusive that your boy got, and I'm trying to help y'all out. So if you're into dividend investing and dividend stocks, check out Dividend Watch's portfolio tracker. And you can even try their free membership. You can put up to 10 holdings in your portfolio, and you get the basic calculator and screener, and you can test it out. But again, make sure you check the link out, and if you do decide to go with Dividend Watch, use the promo code TY15 to get your first year, to get 15% off of your first year membership. All right, now let's go back to my portfolio. All right, guys, so if it's your first time here, you guys should know that my portfolio is mainly catered to dividend investing. Yes, I have some growth stocks. I definitely have some of those, but the mass majority of my portfolio is dividend stocks. So if you look at my diversification, I'm heavily invested into consumer services, and in this category, you will have a lot of my REITs, which are real estate investment trusts. Big into them. Like you see EPRT, that's one of my favorite REITs. I talk about it a lot. And I'm gonna start promoting some of my dividend stocks and stuff. If you guys do watch my channel, you can see that I show a lot of shorts. And that's just because my investing with my portfolio is kind of boring, because I have my stock picks and I keep investing into my stocks, like my dividend money makers. I make sure I keep adding to my position in these money makers, and so I can make sure I get those steady dividends. But like I said, consumer services is my biggest field, and it's because biggest sector, and it's because mainly my REITs. Then I have the technology sector, and of course in the technology sector you got to have your Microsoft, AMD, Apple, Nova. And then in my ETFs, I have a few ETFs too. SPHD, TMFC, the Motley Food Index. But I have talked about these in a lot of game winning portfolios. So first, I'm gonna go show you guys what I did buy since my last weekly update, because I was kind of hoarse, so I didn't let you guys know what I was buying. So since my last game winning portfolio and weekly update, I have been buying Acre as Ares, that's a REIT, EPRT, that's a REIT, and some more Acre, that's another REIT. So you can see I bought 1 Acre, 3 EPRT, 6 Acre, 4 TXLX, which is 6th Street Lending. It's a financial company, but it pays a nice dividend, and it's a growth stock too, if you want to say, because they have been having nice growth and they pay a decent dividend. I did sell one company, and that was AYX, and that company, it was a company for big data, and it really was tanking, and I kind of got tired of looking at it. So if you guys know about long-term investing, if you don't have faith in it, let it go. And that joint was bleeding me bad, so I took a loss on AYX, but it's all good. And that's why you can see that I bought a lot of more stocks than I usually do, because I used the money that I got from those 3 shares of AYX, and I bought more REITs. So this is the holiday season, and usually during the holiday season, the tech industry booms a little harder, because you have a lot of people going in stores and buying a lot of tech. So companies like AMD, Apple, Microsoft, they usually jump up because you have the holiday shoppers going to buy, smartphones. They're going to buy Xboxes. They're going to buy things for, their children or their loved ones. And that usually makes the tech industry, go up. Because, if they're selling more, of course, their stock price is going to go up. So while that's going on, I'm going to go heavy into my REITs and dividend companies, because they are kind of slow around this time. So I'm going to load up on them. And that's what I'm eyeballing while the market is down now too. And yeah, so that's what I'm doing, and that's why I'm doing it. And then you can see they are mainly the things that I bought since the last video. A bunch of REITs and dividend companies. So now let's go down my portfolio. I wanted to go ahead and get that out the way for the people that already know what my portfolio looks like. But now we're going to go down each stock in my portfolio. All right. So my dividend yield on my portfolio is 2.35%, which is pretty good. And I've been increasing that yield over time. I've been steadily buying new dividend companies. And my volatility is pretty decent, 1.22, but that is totally something that Dividend Watch comes up with. So, Dividend Watch can tell you your volatility level. Dividends received this year, $256 in dividends, and that you receive those just for, investing in certain companies. And that's why I like dividend investing. So the market is kind of crazy right now. Everything is going down in the market. But if you are in dividend companies, you can still have income coming into you just for holding your position in each of these stocks. So my annual dividend income is $379, and that's nice because I've been increasing it. If you look at my previous, a lot of the earlier game winning portfolios, I was struggling to get it to 300. Now I'm at 379 a year. And again, I'm going to keep trying to increase that amount because I want to earn money on my portfolio. I want to build a strong portfolio that, I don't have to really worry about. I know it's going to make me money. And that's why I like dividends too. So if you're investing into a lot of growth tech stocks that don't pay you dividends, when you see them tank or go down exponentially, you might feel, oh man, I just lost a lot of money. I'm hurt. But if you're in dividend companies and steady paying dividend companies, the price might go down, but they're still going to pay you your same dividend if you are invested into good dividend stocks. So that kind of gives me a peace of mind, put my mind at ease when I'm doing this investing. And that's why I like dividend investing. Yeah, I throw a little bit of growth stocks in there too, because of course we are young and we want to get some exponential growth. But I'm starting to lean more to cryptos and things of that nature to get exponential growth, just because over the last few years of my investing, my crypto returns are way better than any of the growth stocks that I've been picking. So when it comes to growth, I'm still in good companies and good growth stocks, but I'm starting to lean, not completely, because crypto is risky, and I'm not telling everybody to go invest into crypto, but cryptos are jumping out the gym, and they are beating out any stock that was a growth stock that I invested into. My crypto investments are killing it. All right, so that's just my thought on that. But you guys can check out my crypto updates. I'm gonna do a weekly crypto update, and I'm taking it slow with the cryptos, but you can see exactly what I'm doing in my crypto updates. All right, so you can see my portfolio value is at $19,345. And again, to keep all this up to date, you got to make sure, if you are using Dividend Watch, you plug in your information. All right, Dividend Watch is a portfolio tracker. It's not directly linked to your portfolio. So you have to make these updates in what you're buying, what you're selling. And I do that faithfully on Dividend Watch. Whenever I do something in my portfolio, I make sure I update it in Dividend Watch. So you have to make sure you do that. All right, so total return on my portfolio is 22%, which is great because I steadily add to this portfolio. So it's one thing if you put your money in it and then you just let it grow, because it's kind of hard to track your true growth, because I have been adding to the portfolio each week, adding to the portfolio. So 22% overall is pretty good. It's pretty good. Again, the average stock market portfolio grows 10% a year. The average stock grows 10% a year, and I'm killing that. I'm beating that, and that's what I want to keep doing. All right, now I'm gonna go down my holdings. So we have Apple. And when you click on it on Dividend Watch gives you an excellent breakdown. I love this breakdown that Dividend Watch gives you. So Apple this year had a growth of 32%, which is great. And then they even put the day change in there for you. So I'm sitting around 6 shares of Apple, which is good. My annual income on Apple's dividend is $5.3. I mean, $5.30. So $5.30 is what I earn from Apple. It's not much when it comes to dividend, but Apple is a growth company, growth stock. So Apple has great products. People are probably gonna buy Apple products for the holidays. But Apple is a great company. One of those companies that you don't have to worry about too much, because you know everyone is always buying Apple products. So Apple is a good one, but when it comes to dividend income, not so much. But of course that probably would increase over time. But Apple is one of my good companies that I'm in. All right, the next company, I say Acre, but ACRE. That's Ares Commercial Real Estate Corporation. All right, and this is one of the growth dividend companies that I'm in. I say growth because they had a nice growth for the year. They had a 27% growth for the year, but this company was jumping back from a dip that happened before COVID. So if this company will continue to grow 27% a year, I doubt it. But it was nice that I caught some of that coming up, because it is a dividend payer. So if you find a great growth company or get great growth from a company and they pay dividends, man, that's the ultimate win-win. but I do think this company will probably slow down a little bit. But they had a nice jump because they recovered from COVID. So the annual dividend income for this company is $52.82. That's great. You guys can see that I have less money in this company than I do in Apple, but they give me a much better dividend return. And that's what it's all about. And when you come down to dividends, dang, I should have looked at that at Apple. But when you come down to dividends, you can see how much they increase. And they have been steadily increasing their dividends. So I like Ares Commercial Real Estate Corporation. So let's go back to Apple just for a little quick. So you can see that Apple also has been increasing its dividend. Increasing its dividend payout. And of course on Dividend Watch they have everything. But right now I'm keeping it quick and simple. Talking about the dividend return, the dividend income, and what I think about each company. ADT, that was a free stock. I just haven't sold it. So ADT. AMD had a nice growth. So AMD it doesn't pay a dividend. I don't receive anything, but it's a growth company that I hold, and AMD has been doing great. AMD was one of my best stock picks. As you know, today was a bad day for the whole market, so it's down, but AMD has produced me some nice returns, and that's Advanced Micro Devices Inc. They make chips, and they make chips that's in a lot of things, in PlayStation and Xbox. That was one of the reasons that I invested into AMD about 2 years ago, and it was because it was around the holiday time. I'm like, man, I can't decide, do I want to buy Sony stock or invest in some more Microsoft, Xbox and whatnot. And I was like, what I'm gonna do? I'm gonna buy what's in both of them. In this stock, AMD, I was reading up, they supply chips for computers, they supply chips for Xbox, PlayStations, and so forth. So that was my common sense thinking when I chose AMD. It wasn't because I saw someone talking about it. It was because I was looking at two stocks and I was like, okay, what do both of these two stocks or these two companies have in common, and what do they need in their product? So I got inside their machines and I was like, AMD. All right. And then next up is Brookfield Assets Management. And this company it's kind of like a bank. I say bank because I picked this company over Bank of America back when I did invest in it, because they have assets and they had much better growth than Bank of America. So this is one of my financial companies. I don't have many financial companies, and Brookfield is one of them. And you can see they had nice growth over the last year. 36% is pretty good. They give me a low annual dividend because I don't have a lot in them in this company, but their dividend in this, because their dividend isn't the greatest. You see, I earn $2.75 annually, and they have been increasing their dividends also. Next up, we have Cyber, which is First Trust Exchange Traded Fund, of course, ETF. First Trust ETF, and this fund is for cybersecurity, and a lot of tech stocks are in this ETF, and I bought into this ETF because I wanted some of these tech stocks, but they were overpriced for me. So if you ever want to look up a good tech ETF, make sure you check out Cyber. And as you guys can see, they had a 31% growth for the last year. They pay a small dividend, but it's so small, it's nothing to brag about. That's 54 cents. But I'm gonna be increasing my position in my REITs. Increasing my position in my ETFs in probably like the next few weeks or a month, but they're next up, increasing my position in my ETFs. So ETFs are good to have to give your portfolio balance. Next up is CRISPR. And CRISPR is down. It's down negative 46%. But I still have faith in CRISPR because they have a lot of cutting edge technology when it comes to splitting cells and the whole healthcare field. I definitely believe in CRISPR, so I'm still just gonna hold my position. Maybe I might add another share or two to the position. It just all depends on how things fall. But CRISPR, I still believe in CRISPR. Delta, I have one share of Delta, but the thing about Delta hasn't started paying back their dividends, so I just hold my little one share. I just haven't sold it or anything. I just hold it, and it has produced me some decent returns, but they haven't started paying dividends back, so I don't buy more. I just hold on to my one Delta. Darren Restaurants. Darren Restaurants is next, and Darren Restaurant is doing great, 22+% in growth, and it gives me an annual dividend of $13.90. With what I hold, and Darren Restaurant is a great company. They own a lot of food chain restaurants like Olive Garden, and you guys know COVID had a big impact on those type of companies, and they did have a nice comeback. They bounced back. Next is my favorite REIT, Essential Properties Realty Trust Incorporated, EPRT. You guys should see a lot of videos I talk about EPRT, and the reason I talk about EPRT so much is because if you check some of those videos out, you can see that EPRT came out like in 2018, so it's still like a fresh REIT, and it still has plenty of growth to do, and they pay a decent dividend, so that annual dividend has been increasing, and overall, I get $69 from $69.57 from holding my shares at EPRT, and they have a nice growth. So I'm going to be steadily adding to my position in EPRT. I think EPRT has the potential to become like another O, so I think they can go to O's price. But yeah, EPRT, my favorite REIT. If you don't buy any other REITs that you see from me, EPRT is one of the ones that I would get into. But again, this isn't financial advice. I'm just telling y'all how I feel about these companies. All right, so next up is Fidelity Healthcare Index ETF. And you guys can see they're up 14% for the year. I get an annual dividend of $4.05. And they have been up and down with their dividends, I guess. But it's an ETF. It's an ETF in the healthcare field. I went with the ETF in the healthcare field because there are so many healthcare stocks, right? So I just went with the ETF. I know you got good companies like Johnson & Johnson and a few other names that you could get into, but I just went with the Fidelity Healthcare ETF because, you know, it was an easy pick, an ETF for healthcare. Next up is HECO. HECO Corporation, that was one of my first stocks I bought. So I bought HECO when everything was down in the market, and I just held on to my 3 shares. I bought them. I'm glad I did because, again, I wanted to buy Boeing, and I bought HECO instead, which was pretty good. And you see their dividend increasing. I think HECO is one that can go the distance, and they are a new company, and they still get contracts with the government to build jets and things like that, and satellites too. I think they do satellites too. But HECO Corporation, check them out. Coca-Cola. You guys know about Coke. So Coke is one of the dividend kings, dividend zombies. You know, Coke is an OG. Coke is old. But Coke is a great company. They pay what I don't have a whole lot in Coke, but what I have in Coke, I get a dividend of $18.83. And I have been doing good in my position in Coke. About Coke, they might be down for the year, but I'm up in Coke. And you guys can see Coke ups its dividend each year. That's why they are very reliable. The thing about Coke, though, they are reliable, but they don't have that much growth like that because they are a company that have already expanded its reach to almost everywhere in the globe. But yeah, Coke is a good one. Next up, Lowe's has been hitting all-time highs. You see this? Lowe's is up 65% for the year. Lowe's is a dividend company growing like a dividend stock, growing like a strong growth company. But Lowe's is doing excellent. So I get a dividend from Lowe's of $17, but the growth that Lowe's is doing is crazy. So I'm good with the growth, and it's one of my best positions too. And Lowe's, of course, if you don't know, is a warehouse. Lowe's has a bunch of different appliances, lumber, everything you need to build a house, furnish a house, anything you can think of from your typical warehouse store. But Lowe's is definitely killing the game. I did a video on Lowe's too. And Lowe's does a lot of things in the community. So it's one of those stocks you can be proud of. And you know, the funny thing is, somebody asked me, why do you want to be proud of the companies that you own? Because you do have a part to play in being a shareholder. You do own part of the company. You know, you could own a bunch of cigarettes companies, which we dividend investors, you probably do. Your ETF probably holds a lot of cigarette companies, and you might be killing folks. But hey, that's part of it, right? But, you know, owning a good company is something to be proud of too. All right, so Southwest. I own some shares in Southwest, but Southwest has yet to come back with their dividend. They need to come on back with the dividend though, but they haven't so far. But Southwest has gained me a lot of growth. Right now it says for the year they're down, but I got into them early, so I have been doing decent in Southwest. My position in Southwest. And Southwest has the best balance sheet of all the airlines. That's why I have more Southwest than I do of Delta, because Southwest has a better overall balance sheet, and it's because they also have been in the game longer than like Delta. Southwest has been around longer. Microsoft has also been hitting all-time highs. So I just get a annual dividend of $14.05 from my Microsoft position, but Microsoft has grown 53+% for the year. I can't complain one bit. And Microsoft is a great company. Everybody knows Microsoft is everywhere. Game system, computer. Microsoft is everywhere. So Microsoft is one of those companies that if you invest into, you shouldn't have too much to worry about. Nerd is my gaming ETF. Pretty decent. I get an annual dividend of $2.85 from Nerd. And I've had decent growth from Nerd. So there's so many gaming companies out there. I invested into Nerd just so I didn't have to pick between all of them. But Nerd, check them out. Next up is Northrop Grumman Corporation. Northrop Grumman Corporation is one of my biggest positions. I get a dividend income of $38.64, and I've been doing great in my position. It said they're up 15% for the year. But Northrop Grumman is a corporation that's heavily involved in aerospace, satellites, government contracts, missiles, all of that good stuff. That's what Northrop Grumman is into. So it's one of those companies that the government is basically funding a lot of them, a lot of their work. So I think Northrop Grumman is an excellent company, and I used to work for Northrop Grumman a while back, and all the employees were happy. So Northrop Grumman. Next up is Nova. Nova is my clean energy go-to. It's a solar power company. It says for the year it's down. Is it really? Maybe. I don't know about that. But I guess if they're saying it's down for the year, but Nova is a great company. Sonova Energy International is a great company. And yeah, it's a growth company. It hit the scene. It's still pretty new on the scenes, but on the scene as a public listing. It's a company that's been around for a while, but I think Nova has a distance, and it's one of those blue chip picks it was a blue chip pick for the government. Not saying it's a blue chip stock because it hasn't been around that long, but it was one of the government's picks. All right. Next up is OHI, Omega Healthcare Investor. So it's a healthcare REIT. Yeah, so they invested into a bunch of hospitals and facilities for like elderly, just medical facilities. So that's what Omega Healthcare is, and that's why it's different than the average REIT. But as you guys see, it's down negative 25% for the year. I don't know what's going on with it, but I get an annual dividend of $27.90, and yeah, I think Omega has had dividend growth over the last years, but it's one of my REITs, and that's how I picked them because it's a little different from my average REITs, like from EPRT and Ares, because they are commercial properties. This is solely a REIT for healthcare, and I think the healthcare field is definitely always booming. But yeah, make sure you check it out. All right, next up is Prospect Capital, but it was a free stock. I didn't buy Prospect Capital. It was a free stock. So it is what it is with Prospect. Next up is a company that I haven't added any more money to yet, but it's Phillips 66 Partners LP, and it's an oil company, and it pays a nice dividend. You can see I have one share of this, and I get a dividend of $3.50 because their dividend yield is crazy, 10. But Phillips 66 Partners, I'm gonna add more to this position. I went on and bought into it so I can have a spot in it. And as you guys can see, it increases its dividends over the years, and it's a great company. I just haven't built this position out yet because I have a lot of other positions that I'm building out. So when I get the time, I'm going to invest more into this company. But it's a great company. Next up is SDIV, which is Global X Super Dividend ETF. And it's down. Its price is down, but I'm gonna keep buying more while its price is down. In the future, I get an annual dividend of $14.51 from Global X Super Dividend ETF, and their dividend yield is nice too. And for the year, it's saying it's down negative 21%. But it's a way that I'm investing in dividend companies globally. So I'm not invested into a lot of different global companies. That's why this dividend ETF stuck out to me. It's my way of investing globally into dividends. Next up is SPHD, one of my more heavily invested into dividend ETFs. I have a lot in SPHD, and that's because I was really bullish on SPHD because it's Invesco's S&P 500, high dividend, low volatility, ETF, and Before I knew a lot about dividend companies in the stock market, I invested a lot into SPHD, but now that I know a lot more, I'm more so into buying the individual stocks because I know what will make me money. But SPHD is a great place to be if you want to have a nice annually, monthly income, and you get that steady little growth because it's an ETF. Hasn't done me wrong. Its growth is 11%, and I get an annual dividend of $55.61 from SPHD. I would definitely invest more into SPHD, but I've been branching out more so into the dividend companies themselves because you can get a better return if you know what to buy. And you guys can see the growth. Growth is okay. It's not completely steady, but it's okay. You know you're going to get your monthly dividend with SPHD because it's an ETF, and the whole goal is to get its shareholders their monthly income. Cisco Corporation. And Cisco is a food delivery. They deliver a lot of food to restaurants and things of that nature. They do a lot of different deliveries and stuff, but that's why I went with Cisco. Cisco is a great company, and I knew they were going to be around. As long as restaurants are going to be around and grocery stores are going to be around, Cisco's going to be around. So it's one of those safe dividend plays. I get an annual dividend of $12.96, but their growth is down currently, but I made out decent in my position in Cisco because I haven't added much to it since I've been in it. But they have decent dividend growth. All right, so Cisco Corporation, check them out. I think they're a great company. TMFC, that's the Motley Fool 100 Index. Everybody love the Motley Fool, right? Some people don't like the Motley Fool. I see that. But the Motley Fool, you know, they have stock picks and they stay talking about stocks. But I can feel the Motley Fool because, man, do you guys know how hard it is to make sure you're talking about something stock related each day, multiple times a day, multiple different articles? So I give it to the Motley Fool. You can't talk about them until you actually are doing it, you know. Get to the Motley Fool, it's kind of hard to make sure you are 100% accurate, and that's why everybody give you this warning. Make sure that, you know, you take the risks into account and make sure you do your research because the Motley Fool is decent, and I think their stock picks are decent too. Some of their stock picks are decent, not all. Like I said, everybody isn't 100%, but you got to make sure you do your research. But anyway, I'm buying into the Motley Fool Index, and I like their ETF. This ETF is heavily into companies like Microsoft, Tesla, Amazon. I can't afford Amazon. I probably could buy small amounts into them, but I won't hold shares, man. I won't hold shares. But I invest into an ETF like the Motley Fool, so I can be investing into these big name companies like Amazon. And Amazon is expensive. They don't even pay you a dividend, man. Yeah, man. I don't know about that. If I'm gonna put a lot of money in something, I want a dividend growth company or something. But they pay a little dividend. I get $2.52 from the Motley Fool. Not much, but it's for growth. Motley Fool Index is mainly for growth. And I've been doing decent. Like I said, 26%. So, yeah, if you're looking for an ETF, check out the Motley Fool Index. It's not that pricey yet, but it will be eventually. So, get into an ETF early on before it get pricey. TPGY. This is TPG, Pace Beneficial Finance Corp. So, this company was supposed to be merging with EV Box, which is a company in charge of charging stations overseas in Europe. And yeah, it's kind of been sketchy. They don't know if the merger is going to happen or not. So their stock hasn't been going up like it should be. But this company is a SPAC. And you can kind of, you know how ChargePoint merged with another company. This company should have that type of growth that ChargePoint have if the merger happens. So it's one of those risky plays. Don't have many risky plays in my portfolio. Like I said, I got rid of AYX. That was one of them. And this is the other. So yeah, we're gonna see how that turns out. I keep looking at it. I might end up selling it and moving those growth funds to crypto or something. I don't know. But TBGY, check them out. I did a video on them. You can see what you think. Do your research. Next up is 6th Street Specialty Lending, and this company is great. I'm pumping this company in this and my retirement portfolio because it has great growth and nice dividends yield. It has a nice dividend yield and great growth. So make sure you check them out. It's a financial company, and of course they're involved in lending money out, getting returns on that money, lending it out again. That's why it's called 6th Street Specialty Lending. Come on now. But it has decent growth of 13.28%. And again, I get an annual dividend of $9.84. Steady dividend increasing. They are steadily increasing their dividends. So I like this company. And yeah, so that's my portfolio. Yeah, I ain't keep y'all too long, right? So we back on my diversification, and you guys can see how I'm diversified. I need to up my energy though. Put some more money in Sonova. What's down here? Oh, they don't have Sonova listed in my energy. So where's Sonova at? I wonder. They put them in capital goods and services. Oh, they put Nova in technology. I guess because they are solar power, but I would call them energy too. It's an energy company. So yeah. Anyway, that's me, my game winning portfolio. I appreciate y'all sticking with me. And, make sure that you are doing good in the market. Take your time with your portfolio. Pick your companies out. Do your research on your companies. If you see anything that you do like, hit me up in the comments. I'll let you know what I think about the company, if they're going to keep growing or not. And I appreciate y'all checking me out. Come back and see me. Thanks.